Hello Sector Watchers, welcome to the show. This is the 89th episode of Sector Spotlight for Tuesday the 27th of April, recording it on Monday the 26th. My name is Julius de Kempenaer and I'll be your host for today's show. Again, I should say, because we missed last week's beat. As usual, I'm presenting to you from Amsterdam in the Netherlands. Thanks for those who sent me messages for getting better and my well-being. I just had to cancel the show last week because for some reason I caught a nasty cold, and the worst thing was that I lost my voice, and maybe you can still hear my voice is still a little bit raspy, but that was the reason that there was no show last week. I did test for COVID, tested negative, but as I said jokingly, the body didn't agree because I had a lot of the symptoms, although I didn't lose my smell or my taste. So it's still, well, I'd like to believe that it is still possible that people just get sick and have some sort of a flu, or I don't know, just get sick for a week or two from a nasty cold, not necessarily COVID. But recovered enough, at least enough to do a show today, so we're going to rock and roll. As you know, it's the last Tuesday of the month, which means that we're going to dive into seasonality. So I prepared some seasonal charts and a look into the seasonal performances for the coming month of August. So we're going to dive into that. And I will also try to do an overview and a look back of rotations in asset classes and sectors as they played out over the last 2 weeks. You may remember that in my last few shows I have to say, my outlook for the markets wasn't necessarily positive. I was expecting some sort of a decline, some sort of a pause, and it looked as if we had that last week. And now looking back, in my last show I urged that caution, and then last week we dipped, and now we're back to where we started, or even a little bit higher depending on the markets where you look. So what I'm going to try to do this week is go over the sectors and the asset classes and see whether the premises, the basis for my rationale, the way I looked at things are still holding up, or maybe we need to adjust the view and adjust the sales based on what has happened over the last 2 weeks. So without further ado, let's start with a quick look back and an overview for asset classes and sectors, and after that we're going to dive into seasonality for the month of August. Let's kick off with the rotation for asset classes. On the left hand side we have the daily RRG showing you the daily rotations over the last 5 trading days, and on the right hand side we have the weekly RRG showing rotations over the last 5 weeks. If we go over last week, we can see that DJP, VNQ, obviously strong inside the leading quadrant. So that's one of the commodity ETFs, and real estate. GSG, the other commodity ETF, inside lagging. It's catching up. It's traveling in the right direction. And if we put that into perspective, then we see that both commodity ETFs and real estate VNQ are on the right-hand side of the weekly RRG, indicating that their long-term relative trends are still positive versus VBINX, which is the 60-40% balanced index. So they remain the preferred asset classes even despite this decline here, and you can see that over the last few weeks they're topping the list in terms of performance. If we look at the rotation of last week, we see that stocks were on top of the list with a 2.2% gain. Let's see what happens if we make that a 10-week period. So that's the 2 weeks that we missed. Then DJP is the winner, and stocks are right in the middle. They're sort of in line with the benchmark. So it's in, you know, like last week we had a dip, and now we're getting back up, and so over 2 weeks time, not much happened. Over the last 5 days, stocks gained 2.2%, while the balanced index picked up 1.5%. That means that government bonds or at the bottom of the list with a pickup of 20 basis points. If you look at the rotations, then you see that stocks are inside weakening, but they picked up a little bit, so that tail started to point upwards, and then it's a bit confusing because today the market has just closed. Today we moved lower on the RS ratio scale again, so I'm not sure whether this rotation is going to go all the way back to leading. You see a similar thing with government bonds. It's a little bit more pronounced. It's better visible than on the tail of ITOT. So we hooked down last week, and then today Gov actually outperformed ITOT, or the trend picked up to the right again while ITOT started moving to the left. That means that all in all, market is still not in a very clear risk on preference for stocks over bonds, in my opinion. If you look at the weekly chart, you see somewhat similar. You see that ITOT, right one. The tail has slowed down, which is a good thing, so that's a positive for stocks. We have not hooked or jackknifed back up again, and you can see that Gov is rolling over inside the improving quadrant, so the improvement there seems to be lacking steam. For me, it's too early based on these charts, on these RRGs, on these rotations to make a very clear, outspoken call on the direction of either one of these asset classes. I remain strong for commodities and real estate, and in limbo for stocks versus bonds. And that's also when you look at the individual charts for so here is SPY, and you can see that the relative strength versus VBINX is actually pushing to new highs, but the RRG lines are rolling over, losing momentum. They're still above 100, at least the RS ratio still above 100, so that's a good thing. But it's not the direction of the RRG lines that you'd like to see. If we move to the daily chart of SPY, then obviously this is a positive thing, moving to a new all-time high, taking out that previous high. That's a strong thing. If you look at the RSI, we're below 70, we dipped below 50, so this negative divergence here seems to have done its work. So this was the decline, and we're now back up. Is this the start of a new uptrend? I don't know yet, and I'll give you a little bit more reason later on, hopefully, to give that picture some color and paint my ideas. And one of the things that is still bothering me, or at least something that I keep in the back of my mind as a negative, as something that could put pressure on the market, and that's the negative divergence in the weekly RSI, and that's been building up for a while now. I've mentioned it a few times, and you can see that despite the rise, because I think the first time that we started talking about it was here, that was mid-June, and you can see that the market has gone higher, but the RSI has put in at least two lower highs again. Let's say that divergence is still building up, and before I was preparing the show, I was trying to to find a good word to describe how I look at this chart, because it is going higher, but it's not really going higher. It's not like boom boom, nice, full-on bullish weeks. They're all overlapping, and only the highs of the week are only marginally higher. Even last week we had a serious lower low, and now we ended the week on a positive note, but only marginally higher. And I think that the English word for that is arduous. So the rally is there, but it's laborious, it's arduous, it's not easy. So the ease of movement is not the upside. It's a difficult rally. It's still not all out, and that is something that keeps me holding back, of saying, hey, we've had the decline. We're now in all-out risk on mode again. And that the last chart that I want to share with you on that is the outright relationship between ITOT and Gov. And you can see that the uptrend here, so this is stocks over bonds. You can see that the uptrend here is broken, and this trend is also arduous. It's difficult. We have this new support building up around 3.6, and you can see that this ratio has not been able to take out the previous high. You know, the stock market did take out its previous high, the ratio did not. And I bet you when we would draw an RSI on this chart, well, why don't we do that? It is actually, it will show us a negative divergence. So here's the RSI. I like to look at a 9-period RSI. And there you go. Here is your divergence on that stock bond ratio. So all in all, the reasons for me being cautious based on the asset class rotation are still there. And that's one of the reasons that I'm still in limbo. I'm still not all out bullish for the stock market, and I think that the risk for a decline or sideways movement, sideways correction, time to digest the rally that we had is still there. And that's backed up by a chart like this or the divergence on the weekly RSI for the S&P 500. So much for asset classes. We're going to move on to sectors and sector rotation of last. Okay, for sector rotation, we have the daily image on the left and the weekly on the right. So this shows us the rotation over the last 5 trading days and the performance over those last 5 trading days. And that looks actually pretty good, with energy topping the list at 5.9%, utilities up 0.8%, and the market up 3.8%. But if we go back 10 days, the last 2 weeks, and we look at the performances, then that's still good, but not as good as over the last 5 days. So that's the dip that we had last week, and now we're picking up again. So those last 5 days are looking relatively good, but if you go back 10 days, it's still okay, but not as bullish as this could suggest. Now, if we look at the rotations, then the energy sector obviously is way back in the lagging quadrant and still moving lower. It's picking up some momentum, but it's so low on the RS ratio scale that it remains a very weak sector. And that is definitely confirmed by the tail on the weekly RRG. So look, if you look at the tail for energy on the weekly RRG, that's heading rapidly towards the lagging quadrant. So both tails are moving lower on the RS ratio scale. So that means that energy is and continues to be one of the weaker sectors in the universe, despite this 5.9% rise over the last 5 days. It's not enough to turn around that long-term trend that's underway. And if you look at the energy sector, just thinking about it, that you know, the longer-term trend obviously is one of suggesting to underperform the S&P 500. But if you look at the week-to-week and sometimes even the day-to-day rotations and performances, it's probably a fantastic sector for some swing trading and day trading because the moves are massive. So by all means, if you want to do that, there's probably some good trades to be made there. But from a longer-term perspective and relative to the S&P 500, I'm not a big fan of energy at the moment. If we look at some other sectors, then we have communication services picking up again. Went through lagging last week and is now picking up. But if we look at the weekly, it's actually picking up and going into leading. So they start to reinforce each other again, the daily and the weekly trends versus the S&P 500. So communication services is probably one of the better sectors going forward. And I think that one of the most, well, maybe the most interesting sector is technology. Can't do them all, but if we just pick out a few that are interesting, and the most important tail is the one on the weekly, where you see that technology has just crossed over into the leading quadrant. And it's, by the way, that is happening today because it's the 26th of July. So last Friday we were here on the week ending, the Friday of the week beginning July 19th. It's still a little bit confusing, I know, but this is the week beginning, 5 weeks ending, and it's the week beginning July 19th. So this is last Friday of the week that started on the 19th. If you look at that right now, so today's price action put XLK inside the leading quadrant at a strong heading, and that makes it a positive, that makes it a good sector. And the the rotation here on the daily, as you can see, we had this rotation through leading on the daily chart, which is causing that nice rotation on the weekly tail for XLK. We went or are inside weakening, and we're now, as you can see here, last 2 days, so Friday and today, we're picking up a little bit. So it's good. The odds are good for technology to roll back up inside the weakening quadrant and join the weekly tail again at a strong heading. By the way, it is the strongest sector on the daily RRG right now. It's the highest reading on the RS ratio scale. Another sector that needs our attention is financials. It's inside the improving, rolling over. So we know that it's a relative downtrend versus the S&P 500 on this daily RRG, but it's rolling over now. But more importantly, if you look at the weekly tail, that is rapidly pointing towards the lagging quadrant. So here we have another sector where the daily tail very likely very soon will start reinforcing the move that you see on the weekly, which means an underperformance, a trend of underperformance for the financial sector versus the S&P 500. And there is all that is also going on with utilities. You see that utilities picked up nicely, is moving, but it's already starting to lose momentum. And if you look at the weekly tail, then you see that it is the weakest sector right now, rolled over while inside improving, rolled over, is now back into the lagging quadrant and at a negative heading. And this loss of momentum already starting before that daily tail was even able to hit the leading quadrant. Even if it goes into the leading quadrant at negative or losing momentum, it's very likely that it will roll over and join forces with that weekly tail for utilities. Let's go over with materials. That's another sector that's not doing too well. You can see that that weekly tail is pointing rapidly towards the lagging quadrant. And that's also here on the daily RRG rolling over while inside improving. Very unlikely that this will continue all the way back to leading. Most likely this will continue to roll over and join forces with the negative direction of the tail for materials. So another sector that is very likely to underperform. That's probably the biggest message that I have for you right now in terms of sector rotation. Especially if you look at the weekly RRG, there are very few sectors that are showing an outperformance, let alone a strong outperformance. It's technology, it's communication services, it's real estate in a good uptrend, but that's temporarily losing momentum. And we have this one here is discretionary, that's picking up inside, improving on the weekly chart. Let's have a look at that one's right here. That is this. It's lagging the technology sector a little bit. It's inside weakening, starting to pick up, but not massively. Could go into lagging, but here you see it's in improving. It's not fantastic, but the direction of the tail is good, so that's a positive sign. But that means that we have, well, discretionary maybe. We have technology good, and we have communication services good. And if you look at the rest of the tails, the remainder of the tails, they're quite disappointing. They're pointing to underperformance versus the S&P 500. So the question is whether technology and communication services on their own will be able to keep this market higher. So that's another piece of my evidence, piece of the stuff that I look at, that holds me back from going all out bullish on the S&P 500. Because when in a situation where the market, goes all out and blasts through new highs and goes into that strong uptrend, you want to see, technology and communication services for sure, but also like materials, industrials, discretionary, much further to the right. Maybe even the sector like financials picking up. You would like to see utilities, staples, that kind of stuff. They are on the defense, but not very pronounced. There is not a very pronounced difference. It's not like a real good split of that sector rotation, and that all in all, it's spread out and there's only a few sectors that are at a positive RRG heading. All in all, that makes it difficult to become super bullish on the S&P 500. I still think that there is risk involved in this market, despite the recent rally of the last few days and the break to new highs. As I said, negative divergence, only a few sectors outperforming. I remain cautious for the time being. So from a seasonality perspective, there are a few interesting observations to make for the coming month of August. If we look at the chart as you are used to from me, the 3D chart showing you the average percentage of outperformance for the various months per sector, then there are actually quite a few that are worth looking at. Communication services having allegedly a weak month of August, but you can see that it picks up again in September and in October. Energy having a weak perspective for August, and then September is sort of okay, and then it drops off in October. Financials actually pretty weak in August, and then sort of 50-50 in September and October. Technology going into a strong August, potentially a dip in September, but then a really strong October, so that's definitely a sector we need to look at. And then real estate holding up strong still in August, but then leveling off and dropping into September and October. Same goes for utilities, allegedly a good month of August, but leveling off in September and October. And then healthcare, strong into August, 50-50 in September, and then dropping to a very weak October. So this is a bit of the outlook and the perspective that we're looking at. If you look at the expected performances, then the most interesting ones come from energy, which is expected to lose 1.4%, or I gotta say that differently. On average, the energy sector lost 1.4%, underperformed the S&P by 1.4% in August over the last 20 years. And it's continuing to do that in September, a little bit less, but then in October, again, losing 90 basis points versus the S&P. Financials losing 40 bips, but technology picking up 40 bips in August, as we saw that dip in September, and then a real strong expectation for October. And then we got real estate, which is okay-ish, but on average in August, real estate is showing a real good performance, followed by a little bit less in September, and it dips negative towards the end of the year. Utilities, 40 bips, so. And then healthcare minus 0.1. That's interesting because if you remember the previous slide, healthcare is actually 65% of the time healthcare is showing an outperformance, but the average performance over the whole period is minus 10 basis points under the S&P 500. So that's a little bit of conflicting data there. Now, if you've seen the previous show with the seasonality for July, you remember that I'm working on this new visualization where we have all sectors and then we have this seasonal snake, I probably should say, where we are actually looking for thick dark greens and thin dark reds. Those are the most interesting ones. If we quickly go over the ones that we have identified already on the previous 3D chart, then energy, 40%, so 40% of the 60% of the time it's underperforming, but the most important thing is that the average return is minus 1.4%. So that's definitely a focus on the negative for me. We have a similar but slightly less pronounced for financials. 65% of the time financials have been underperforming the S&P 500, and the average return is 40 pips below the S&P 500. Then we have technology, which is interesting because it's 65% of the time outperforming the S&P 500 with an average return of 40 basis points over SPY. And then most interesting, 58%, almost 60% of the time real estate is outperforming the S&P 500, but the average return is 1.2%. So those are the 4 sectors that I think are most interesting to watch from a seasonal perspective. I'm going to put them, we already saw the rotations. I'm going to give you a slide that summarizes all of that later on. And here is the healthcare sector showing that weird thing, because 65% of the time, and then an average performance which is below the S&P 500. So there's some confusing data going on there. Let's have a look at the summary slide, I should say. And that is this one here. These are the sectors that are having the high and the low percentages and their average performances. So communication services from a seasonal perspective is negative with 30% and an expected underperformance. But as we saw on the RRG, the tail is actually looking pretty good. So there's not aligning. Energy, on the other hand, is weak on the seasonal expectation. It's definitely one of the weakest performances on average. And the RRG is showing you a negative tail. So there is a sector where the seasonal and the actual rotations are aligning. So I'm putting 3 exclamation marks there. That's definitely one to look at from an underperformance perspective. Similar for the financial sector. 35% of the time it's outperformance. 65% of the time this sector is underperforming the S&P 500. And on average it's losing 40 bips below the S&P 500. And also on the RRG, the tail is pointing in a negative direction. Definitely a sector to watch from a negative perspective. Technology, strong seasonal pattern. 65% of the time we're outperforming. And on average, the sector is beating the S&P 500 by 40 basis points. And it is showing a strong tail on the RRG. So definitely a sector to keep an eye on from a long perspective. This is probably one of the strongest sectors going into the month of August. And then we have real estate. Not 3 exclamation marks, but definitely one to keep an eye on because the seasonal pattern is strong. 60% of the time the sector is outperforming the S&P 500. But on average, it's outperforming the S&P 500 by 1.2%, 120 basis points. On the RRG, as you remember, XRE is on the right-hand side, but it's rolling over to the right. It's still one of the stronger, if not the strongest sector from a relative strength perspective. So if that turns around on the right-hand side, then we could see that 1.2% and that outperformance. But the tail at the moment is not yet confirming that seasonal pattern. We still have this week to go for that to pick up. So, you know, definitely worth keeping an eye on. It's definitely not a negative sector, let me put it like that. So where to watch? Energy and financials from a negative perspective, technology, and as a surprise act, maybe real estate from a positive perspective. I think that's the most important message from seasonality and RRG going into the month of August. And that already wraps up Sector Spotlight for this week. I hope you enjoyed the show. If you did, please give us a thumbs up. Leave your comments below. If you've been following the show, you know that I will respond on the channel that you are putting your comments and your questions in. Maybe not the day after, but usually I respond to all my comments and my emails. Thank you again. Thank you for watching. Thank you for the messages last week. I hope to see you back next week at a new episode of Sector Spotlight. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Thanks again and see you back next week at a new episode of Sector Spotlight.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.